Oh, thank you for joining us today for the live release of NEPC's 20th annual DC Plan Trends and Fee Survey. And for those of you joining us on the replay, welcome back. We're glad you have carved out some time for us. My name is Mikaylee O'Connor, and I lead NEPC's Defined Contribution practice. I'm going to be moderating today's discussion, and I am joined by three exceptional DC consultants who I would say spend most of their days in the trenches with our DC plan sponsored clients. We have Alison, Lonstein, and Emma O'Brien, who are partners at NEPC, and Allie Riley, a consultant on our DC team who has been instrumental in this year's survey. Now, collectively, I would say that they bring a practitioner's perspective to what's been working, what's evolving, and where we still want to focus on going forward. Our goal today, I would say, is pretty straightforward. We want to share with you the most meaningful trends that we're seeing across the DC landscape. Some of these are newer developments. Others have been building for quite some time. We're going to cover fees and how they have evolved over the last 2 decades, how participants are actually using their DC plans, and then what's been changing across investment design and implementation. Now, I would say importantly, our goal is to really focus on what this means for plan sponsors, right? What deserves your attention, what may require a rethink, and where incremental decisions may have an outsized impact on participant outcomes. Now, I know Alison, Emma, and Allie each have their prepared remarks, and so but I would say this is by no means supposed to be a one-way conversation. I know a lot of webinars are these days, but we very much welcome your comments and questions throughout the discussion today. I'm going to be actively monitoring the chat, so please do send them over as they come up. We are going to try and address as many as we can over the next, I would say, 45 minutes or so. And if we don't get to yours, or if they require kind of a more complex response, then we will do directly after the webinar. Before we dive in, I do want to set the stage a little bit on the background of this year's survey. As I mentioned, this is the 20th year NEPC has conducted our DC Plan Trends and Fee Survey. This year's results are based on year-end 2024 data and represents 276 defined contribution plans. Now, I would say the breakdown is fairly consistent with prior years. As shown on the middle of this page, we have roughly 66% across the corporate plan space, 26% healthcare plans, and 8% across public, not-for-profit, and Taft-Hartley. In total, these plans represent $448 billion in assets. That's up from $408 billion last year. And on the right side of the page, you'll see the average plan size of about $1.6 billion. Now, one of the statistics that I would say matters the most to me is the 3.2 million participants represented in this data set. You know, at the end of the day, our role as consultants isn't about benchmarking for the sake of benchmarking. It's about helping employers and plan sponsors improve retirement outcomes for real people. And so having participant level data allows us to really better understand behavior, engagement, and decision making, where participants are well served by plan design, and where friction or complexity still is getting in the way. And so, these insights really allow us to move beyond the broad trends and really try to get into the actionable guidance. And so over the years, we've developed several proprietary tools to help us extract sharper, maybe more practical insights from this DC data. And you'll hear a little bit more about that today during the discussion. But before I turn it over to Allie, I want to acknowledge the work behind this survey. This is truly a labor of love. I know I say that all the time, but Pulling this together, validating and synthesizing this amount of data takes a tremendous amount of time and care. And I want to thank members of our DC team, especially Allie and Kent Dinlek, to our broader consulting teams, to the record keepers who provide a lot of this data, and most importantly, to our clients. Your willingness to participate in this is what makes the survey valuable each year. So with that, I'm going to hand it over to Allie to talk DC plan fees.
Okay, thank you, Mikaylee. To begin, we'll start with the results of the fee portion of our survey. And with that, we wanted to start off with a look back over our survey participants over time and also the impacts on the overall fee landscape. So as you can see on the slide here, we've seen very meaningful growth in our survey participants from an absolute perspective in terms of the number of plans that we're including, as well as from an asset and participant perspective in line with overall DC industry growth. Along with the growth in the DC industry, we've seen a striking decline in investment management and record keeping fees. If we focus in the bottom left-hand corner of the page, we've seen a 67% decline in investment management fees coming down from 57 basis points at the inception of the survey 2 decades ago to 19 basis points with this last year's fee survey results. Shifting over to record keeping fees in the bottom right-hand corner of the page, we've seen a 26% decline in base record keeping fees over the last decade as providers expand services and face market overcapacity. If we move on to the next slide, we'll take a look at the results of the fee survey across relevant peer groups. We'll start with the results of the base record keeping fee analysis highlighted at the top. Overall, as you can see, as plans increase in size, base record keeping fees decrease as pricing becomes more competitive. Although this is, a great starting point for the conversation, the base record keeping fees is not the only fee that we're evaluating within the context of our report. This year, we meaningfully expanded the data that we collected to help provide additional perspective to the results of this base record keeping fee benchmarking. We looked at client-specific factors such as plan type, industry, number of plans that are included in the overall relationship, and we also looked at additional sources of revenue for record keepers such as float income, managed account revenue, participant transaction costs, proprietary product offered within the plan, and additional services provided at the client level, all components that we know influence the base record keeping fees. This has provided our clients with additional perspective as they've evaluated their positioning within the peer group shown on the page here. As a best practice, we'll continue to recommend issuing an RFI or RFP for record keeping services every 3 to 5 or 5 to 7 years to provide that really full apples to apples comparison and to document the due diligence process. As we wrap up with the results of the fee portion of our survey, I'll focus on the bottom chart, which provides a review of total plan asset-weighted investment management expense ratios. As you look across the page here, you see a very similar trend as the record-keeping fees above. As plans increase in size, fees tends to decrease, and as plans benefit from competitive pricing. However, investment structure and asset allocation also remain highly influential to the total plan asset-weighted expense ratio, as trends such as shifts towards passive management and target date funds, as we'll touch on here in a little bit, also meaningfully impact these fees. So Mikaylee, I'll pause here to see if there are any questions before turning it over to Alison to dive into investment structure trends.
Yeah, perfect. So Allie, there actually was a question that came in regarding float income. Maybe could you provide a quick definition of what float is and where it comes from?
Sure. Float income is generated off of any plan assets that are uninvested. So the most common type example for that would be uncashed checks, where a record keeper will invest these assets in short-term money market type investments, and whatever income is generated off these assets is considered to be float income. So years ago, this was all revenue retained by record keepers. However, we've seen a meaningful shift over the last several years with more and more record keepers rebating this float income back to plans. And in fact, this is generally an important negotiation point that our vendor management team incorporates when conducting RFIs and RFPs for record keeping services.
Perfect. Maybe I would ask, when we look at this data, how should plan sponsors use this for their fiduciary governance?
Sure. From a record keeping fee perspective, this annual exercise should be used to help document whether your plan fees are reasonable relative to other plans of similar sizes, and for to consider the additional sources of revenue received by a record keeper. That should help provide some context as to where you kind of fall within this peer group. And that might help inform a plan sponsor whether they need to consider doing an RFI or RFP a little bit sooner than they might have originally planned, or whether they can kind of push things back and wait a little bit longer. From an investment, management fee perspective, it's not shown on the page here since this is the results of the peer group analysis, but included in our full review for our clients is a lowest fee share class analysis where we take a look at all of the investment options offered inside of a plan currently today and evaluate whether there are any additional opportunities to lower fees by transitioning to a lower cost share class. So whether that's a new share class offered based off of the assets that are included within the plan that have gone up, or if it's a new one that's created by an investment manager, this lowest cost share class review will take a look at all of that to ensure that the lowest cost fees are being offered within a plan.
Got it. And we actually just did have another question come in regarding managed accounts, which we are going to talk about here very soon. But do we have any similar data on managed account fee trends that we can share?
Yeah, so this was another aspect of fees that we did take a look at within the context of our review this year. And very similar to the exhibits that are shown for the base record keeping and investment management fees, the size of the plan is a driving factor when it comes to managed account fees as well. Because of the unique revenue arrangements associated with managed accounts, sort of an additional influencing factor is the record keeping platform itself. Because oftentimes the record keeper is either the provider of the proprietary managed account service or they're sort of the conduit of a third-party product. In terms of just the overall range of fees that we see, most managed account fee schedules are based on a tiered schedule, and we see fees as low as 5 basis points to a high of 60 basis points, with the most common fee range between about 25 to 45 basis points. And then maybe one last point here is that, as I mentioned, this year we reviewed additional sources of revenue and the impact on base record keeping fee pricing. And what we found was that for larger plans, managed account fees oftentimes were used as a lever to increase or decrease record keeping fees based on whether the proposal was inclusive or exclusive of managed account assets. So overall, it's just a very important component of the record keeping fee reviews and renegotiations these days.
Yep. And just to clarify, there was a question that came in asking if this data on this page includes any managed account fees, I think on the record keeper side, and the answer is no.
That's correct.
Yeah, exactly. Okay, perfect. I think that's all. If we want to move on to you, Allison.
Great. Thanks, Allie and Mikaylee. So we're going to shift gears a little bit and spend the remainder of the webinar focused on investment structure and the current market dynamics that are driving change across DC plans more broadly. So this year we've introduced a new exhibit here that serves as a roadmap. It really highlights the key factors that influence investment structure and ultimately participant retirement outcomes. So as we think about our approach and how we work with clients, we really start from the ground up. So we look closely at participant behavior, how they're actually utilizing the investment options and tools available to them in their DC program. And then we pair that with a top-down perspective, incorporating broader market trends and focus areas you see outlined here in the roadmap on this screen. And so the following slides will unpack several of the most meaningful trends we're seeing, including a meaningful shift towards blended and passive target date fund implementation, structural changes within the core menu, particularly the movement we've observed within US large cap equities. We'll also touch on the continued focus around managed account services, share insights on custom solutions, and discuss what we're seeing when it comes to alternative investments in DC programs. And as we kind of bring all that together, I will connect these themes back to the broader market forces shaping plan design decisions, forces that have led roughly 30% of plans to initiate lineup changes over the last year. So if we turn ahead to the next slide, which focuses on participant statistics, there's a lot of numbers here. I'm not going to go through every one, but I think the key takeaway on this slide is that participants on average hold about 3.6 funds. So what this highlights to us is that regardless of how broad or robust a plan's investment menu may be, participants are typically selecting only a small number of options to build their portfolios. Now, some of this is obviously driven by the heavy use of target date funds, but even when you carve out the target date fund users, the average number of funds held is still only about 5.2. So even among those DIY or do-it-yourself participants, portfolios still tend to be fairly concentrated based on the number of options that are held. And if we double click those averages and break them out by age, what you could see across the different the different career stages in this second row here on the table here is that we were highlighting younger participants starting out in their career all the way up to near or in retirement. And what you can see is that the average number of options does increase somewhat as participants get closer to retirement. But looking ahead over the next 10 years or so, we would actually expect the number of funds held to decline. And that's largely because we continue to see the majority of contributions flowing into target date funds, which has prompted many plans to adopt a more streamlined menu structure overall. It's also important to highlight that these figures represent the average participant experience across the survey population. So what we like to do is conduct a more detailed bottom-up analysis through our participant investment efficiency review or peer. And what we find is that often these stats vary meaningfully from plan to plan. And this really underscores the importance of understanding each plan's specific participant behavior and aligning the investment structure with the client's unique objectives as we think about evolving the core menu over time. And so again, from our perspective, this reinforces two things. First, the importance of offering a target date fund that is suitable for your plan's population. And second, complementing that with a streamlined, thoughtfully constructed, and broadly diversified core menu. So maybe with that, we'll go ahead to the next slide, which takes a deeper look at target date funds. And first, no surprise here, we continue to see assets flowing into target date funds. So as contributions increasingly are defaulting to these strategies, we now see them representing a pretty meaningful share of total assets of about 48% on average. Again, this dynamic has really put pressure on the core menu and it has contributed to the broader trends towards streamlining. And at the same time, we've also noticed a notable shift in implementation. So there's been a continued movement away from active target date fund strategies towards more blended or passive approaches. So today we're seeing close to 60% of plans offering passive target date funds, which is reflecting a clear preference towards lower cost structures along with increased glide path flexibility that we've seen across many passive providers today. So just in terms of some of the themes we've seen more broadly across the target date fund space, many of the larger target date fund providers have expanded their offerings in recent years to include different risk levels across the glide path. So that could be offering more conservative, moderate, or even more aggressive, which has been growing increasingly popular among plan sponsors. Generally, we've been supportive of these evolving options, and we do believe they've been a welcome addition to the target date fund universe. We've also seen other innovative ideas across personalized target date funds with retirement income focused features, such as providing participants the optionality to annuitize a portion of their assets in retirement, and also target date funds that include alternatives. This has obviously been an area of interest and a lot of conversation. And if we think about target date funds and the fact that they hold nearly half of DC plan assets, we do believe this is one of the most practical entry points for incorporating private market investments into a lineup. And within custom target date, we still see and have seen for several years real estate being the most commonly utilized private asset. That said, we are starting to see some other asset classes being incorporated, like private equity and private credit, and we'll continue to monitor this over time for our clients. I'll say we've seen a lot of asset managers actively bringing these solutions to market. But I will say plan sponsors have generally been a little bit more thoughtful and cautious in their approach, really wanting to better understand things like fees, liquidity, operational considerations, and overall participant fit. So one way we've helped our clients evaluate these changes is through our proprietary forward-looking application called POM, or it stands for Participant Outcomes Modeler. And using POM, we're really able to educate our clients on the impact of participant outcomes by assessing their target date fund's ability to accumulate wealth in retirement for participants, also across different economic environments, as well as longevity of retirement income. And then finally on this slide, when we think about participant behavior, we do note in this bottom table here, a meaningful portion of participants are invested 100% in 100% of their assets in target date funds. You can see that in the second to bottom row on this page. And so again, all of this just really enforces the critical role that target date funds play in plan design, and the fact that they represent the main retirement vehicle for many participants. I've seen Mikaylee has come on the screen, so
Yes.
maybe we have a question.
I do have a question for you. So you had mentioned several themes within the target date fund space. Are there areas where you've seen maybe more interest or more adoption or change within any of those?
Yeah, I would say one of the areas we've had the most interest is with clients rethinking the overall risk profile of their target date fund offerings. So I mentioned we've seen several passive providers in recent years introduce new versions of their target date funds that allow for take on greater risk and include higher allocations to equities. This has been of interest to our clients. I'll say one example I have is a client where we utilized our peer tool, wanting to understand of your target date fund users, how many of them are utilizing, I'll say, the correct target date fund vintage based on their age. And what we found was that many of the participants that were near or in retirement were actually selecting a vintage that was more aggressive than where we would expect them to be. So this ultimately led this client to make a change to their default to better align it with their changing participant needs. All right, Mikaylee went off screen, so I'm guessing that's it for target date funds for now. So maybe we'll move ahead to the next slide, which starts to talk about the core menu. So on this slide, what we're doing, we broke down the roughly 280 plans included in this year's survey into 4 groups based on the number of core options that are offered. And as we think about investment menu design, it's important to emphasize there really is no one size fits all approach. We view each plan separately, and we really want to design it to be based on clients' specific participant base and align with committee's objectives as well. So you can see how that plays out here. There's a pretty wide range of in terms of the number and types of options that are offered across plans. You could see the most common structure falls in the 11 to 14 core option range, which represents about 49% of plans. And again, just to clarify, these are the core options that are intended to complement the plan's default. So these numbers do not include the target date funds. And in terms of streamlining trends, one notable shift we've observed is a reduction in the number of equity options offered, which is represented in the middle part of this page. Emma will unpack that a little bit in a moment. But the other thing that's new on this slide here is on the far right-hand side of the page, we're showing an asset class column. And this is really meant to illustrate an important point, is that as you move down this page, the number of asset classes offered is less significant. The change in the number of asset classes offered is less significant than the change in the total number of core options. So in other words, plans with a larger number of options aren't necessarily offering exposure to more asset classes. They may simply have more overlap with the same asset classes. So this really ties to one of our core beliefs about purposeful plan design, and each investment option should play a distinct and intentional role within a program. And with that, I'll turn it over to Emma to talk more about how the core menu is evolving.
Great, thank you. So as we start to dive into the prevalence of common core menu options, it's helpful to know what other plans are doing. However, just because a lot of plan sponsors currently offer an asset class or an option type, that alone doesn't signal that it's prudent or purposeful to offer that. Our message to clients has always been to not feel uncomfortable moving away from your peer group based on your own plan's goals, demographics, and cash flow patterns. So as you look down these asset classes on the left-hand side of the page, you have target date funds as the most commonly offered, and then you have the building blocks that make up the traditional active and passive tier with US large cap, US mid, non-US, and core bonds that are all commonly offered. As you continue moving down the page, you start to see asset classes that have been removed from lineups with continued streamlining. Things like dedicated emerging markets equity, high yield, balanced funds, and so on. A few notable items to point out. First, active large cap continues to be a topic of discussion. So if you think historically, it was very common to offer style options, meaning value in growth within active large cap. And there's been two layers to the discussions that we're having with clients. The first is for clients who offer style options, does that continue to make sense? Styles go in and out of favor. That has been particularly true for large cap markets as growth has significantly outpaced value over the last decade. So moving to a core option, whether it's in an index fund, an active large cap core, or creating an active white label fund that's core in style, is a way to remove style drift in participant portfolios and provide hopefully a smoother performance pattern. So we thought it would be useful to look back at our clients in 2020 versus our clients now to see what changes have been made. And if you look on the right-hand side in the blue box, in 2020, 71% of clients offered style options in large cap. That number is 67%. So still the majority of plan sponsors have style buckets within large cap, but we're starting to see that number come down. Which leads me to the second part of the discussion is that for clients who have active large cap, whether it's a standalone option or within a white label fund, does active continue to make sense for this bucket? Large cap broadly is a very efficient asset class. It's been tough for active managers to add value. Large cap growth has been incredibly challenging to outperform given the index concentration from both a holdings and a sector perspective. So there's been an ongoing dialogue with clients on whether it makes sense to implement that exposure passively. Over the last 5 years, 12% have removed an active large cap growth fund, and 32% of clients have made structural changes to their large cap options, and we expect this trend to continue. In terms of the next trend we're seeing from a structural perspective, on the capital preservation front, we think over the long term, stable value is the appropriate option as it should outperform money market. However, in the current rate environment dating back to 2022, when the Fed started raising rates, money market has outperformed stable value. And that's led to questions from clients and committees on whether stable value is still the appropriate capital preservation option. Despite those discussions, though, we haven't seen much of a shift. As you can see in the green boxes on the right-hand side of this page, 76% of plans offer stable value, 50% offer money market, which is in line with the stats from 5 years ago. And then the last comment I make is on the active fixed income front. Core Plus continues to be the prevalent choice, with 70% of plans offering relative to 20% offering core bonds. As plans have streamlined the number of options, Core Plus is a useful way to get exposure to plus sectors like high yield, emerging markets debt, and so on to bridge the risk return gap between core bonds and equities. If we move forward a slide.
Hey, Emma, sorry to interrupt, but as I'm looking at this slide, what has been the biggest maybe disconnect between investment design, right? These are the prevalence of the offering of investment options and behavior, right? Behavior from a plan sponsor or participant perspective, right?
So this is where our peer tool that Alison was referencing can be really helpful in breaking down participant utilization because the answer to that question is going to vary on a client by client basis. So for example, on the large cap discussions, we broadly see core menu participants overweight US large cap. But at the plan specific level, we can use peer to break down how participants are actually accessing large cap within your plan. So are they passive only? Are they active only? Are they pairing both together? And then in situations where there are style options, we can look at style drift and portfolios. Another example would be on the target date front, where we can run the peer analysis. If we find participants are using multiple target date funds or pairing target date funds with core menu options, that could lead to a targeted communications campaign.
Perfect. Thank you. Next
Okay.
page.
Why don't we go to the next page? Yes. So as we transition to talking about custom funds or white label funds, if we take a step back, we're an advocate for offering white label funds when you can achieve a benefit above what you can get in an off-the-shelf fund. We often say plans graduate into custom. Once you start to have scale, which is about 100 million in a core menu option or 1 billion in target date funds, the operational cost to administer becomes de minimis. However, in practice, we typically see plans consider implementing white label funds once they cross the, call it 250 to 500 million mark in a single option. And that's why you see white label funds offered more commonly in the large and mega market. So 21% of clients broadly use custom solutions, but as plans get larger, as you could see on the top left of this page, that number increases with size. So 52% of plans greater than 5 billion have white label funds. We think one of the biggest selling points on white label funds has been from a risk management perspective. Plans are continuing to grow, and as they grow, it gets more and more challenging to find managers that are appropriate for a DC plan and have capacity at a higher asset size. So it's really a way to limit manager concentration. As you look on the right-hand side of this page, on the top right, where we're showing asset classes that are implemented in a custom format, that's why a key driver why US mid-cap is the most commonly offered white label fund with 95% offering, as this can be a capacity-constrained asset class. Tying back to my comments on active US large cap, this is also where we've seen some clients who want to keep active large cap get creative by pairing active large cap value with a passive large cap growth fund. We move forward one slide on managed accounts. Currently, 48% of plans offer managed accounts, with 10% of participants utilizing the service and 9% of assets invested in managed accounts when offered. The key trend with managed accounts is reevaluating the value add. Since December 2023, we have seen 14% of plans with managed accounts terminate the service, and that's largely been driven by stalled fee negotiations. If you've joined our webinar over the last 2 years, we've talked about how there's been disruption in the industry with new entrants to the market coming in at lower fees than the more established providers. Managed account fees have been challenged from a litigation perspective. And we've done a lot of educational sessions for clients on this topic. We also have proprietary tools we can use to analyze the efficiency of managed account user portfolios and quantify the impact of fees on participant outcomes. And that research has led us to actively negotiating managed account fees on behalf of our clients. It's resulted in some plan sponsors turning off managed accounts, and it's resulted in a decrease in fees for clients. One interesting point from the survey is that if we look at the percentage of managed account users enrolling in the service, only 11% of participants in retirement are enrolled in managed accounts. And when you look at the distribution, retirees are only 10% of all managed account users. Assistance with the spending phase is an area that providers will tout as a benefit, but the reality is that not many participants in that age group are enrolled in the solution.
Hey, Emma.
Yes.
Sorry, I was having user difficulty with turning my video on. Um, can I go back a page?
Sure.
Because we do have a couple questions that came up and on custom funds. And the first is, are we seeing any sort of, let me just make sure I get this right, um, interest in increasing, decreasing, staying the same in terms of usage of custom or white label funds? Um, I, I know we don't have the data here right now, but like tangentially, just based on your kind of experience, what have you seen over the last several years?
In the core menu, it continues to be an area of discussion. Again, as you go back to as plans get larger, you have more assets within your core menu options. It can be challenging to find managers or high quality managers that have capacity. I'd say on the custom target date fund side, there's been less interest than if you look back 5 or 10 years ago. Historically, if you wanted a glide path with more risk, you either had to implement that actively or in a custom target date format. Alison talked about passive providers have launched alternative glide paths with higher risk levels. And when you pair that with the fact that passive target date fund fees have decreased substantially over the last decade, I'd say there's a higher hurdle to considering custom and the complexity behind it.
Okay, perfect. The second question that kind of is related to this slide
Mhm.
is, and I'll paraphrase this, but how should plan sponsors? There's been a lot of talk about private investments, right? It's been in the news a lot. But how should plan sponsors, or how are plan sponsors like approaching this topic within kind of the DC plans? I think this is a good page to kind of start that discussion.
Yes, I mean, private markets was definitely one of the biggest discussion items amongst the industry in 2025. Custom funds and specifically custom target date is where we typically see more usage of alternative investments. Private real estate is the most common private asset used in custom target date funds. 58% of custom target date fund clients allocate to the asset class. The other area where we could potentially see it is on the core plus side, where private credit, as more funds are launched, could be considered as part of a diversified bond fund in some cases.
Perfect. Thank you. All right. Should we move to this
Yeah,
last line? Okay.
perfect.
Okay.
So as we transition to talk about retirement income, we think there's a misconception in the industry and that there's this assumption that to have a retirement income solution means that you have to offer an annuity in the plan. We believe retirement incomes is a broad umbrella term for how participants will spend down their asset balances within DC plans. And we think plans that offer a combination of target date funds and systematic distributions offer a retirement solution because you're giving participants the ability to de-risk in retirement and essentially receive a monthly direct deposit from their 401k plan. 89% of plans fall in that bucket, so a majority of plans do offer a type of retirement solution for participants. However, usage of the feature is still quite low. So if we look at all the participants that fall in the 65 and older bucket, 15% of participants in our survey fall in this age group. Only 5% of those participants are taking systematic distributions. So this could be an opportunity for plan sponsors to work with record keepers on educating participants on the retirement income features already available in the plan. This is also an area where we could see potential innovation if you have a target date fund provider put in a systematic withdrawal feature as part of the suite. The last thing I'll mention on this page as a plan sponsor, the reality is you don't have access to all the information about what participants need in retirement because that's going to vary on an individual basis, but there are ways to help. So in addition to communicating and educating participants on the distribution options available in the plan, it can also mean educating participants on account consolidation. The median 50 to 59-year-old has 3 separate retirement accounts. 31% have 4 or more based on a recent Vanguard survey. And promoting account consolidation can help participants maintain a more holistic picture of assets in their retirement plans. So with that, I will turn it back to you, Mikaylee.
Perfect. Great. So I think we have covered all of our prepared remarks. There are still some questions in the chat that I think we can all try to address. And then I have a couple questions as well, just from a broader perspective. So maybe I'll start with you. I'll give this to you, Allison. Touched a little bit on, actually, both you and Emma touched on this a little bit, but given the strong equity markets the last several years, particularly within the US, are we seeing participant, behavior change? Has that been something that we're observing, and what are we doing about it?
Yeah. I'd say a couple of observations that stand out here. First is we've seen increased contributions flowing into passive strategies, particularly in the US large cap space. So this kind of aligns with Emma's earlier comments around consolidation in the asset class. But what we've seen is the participant behavior has actually reinforced some of those client decisions, really emphasizing passive solutions in this segment of the market, reflecting some of those preferences. Let's see. I think another area maybe is just thinking about, again, US large cap and just the overweight we see. So the average plan, most DC plans, if you look at the DIY participants, are overweight to US equities. And when we unpack that a little bit further for those plans that offer separate growth and value options, what we often see is a notable tilt towards growth-oriented strategies. So this has led when we utilize our peer tool again, this has led some plans to think about wanting to shift towards a more style neutral core offering to help solve for some of those, I'll say, less intuitive allocations.
Perfect. Maybe going to you, Emma, just regarding managed accounts. This is more of a clarification, but does the data that we show on managed account, are we able to differentiate between plans that use it as the QDIA and those that use it as the opt-out option? Maybe you can touch on, the prevalence of managed accounts as the QDIA and what are some of the differences we see there, just briefly.
Sure. So we could dig through the data and differentiate between those that have it as the default versus not. The overwhelming majority, 96% of plans have target date funds as the default. So you're not going to see a strong skew in the broader data set. That being said, if managed accounts are default, you would expect to see higher participation rates relative to what we showed in our survey, both in terms of participation as well as asset levels as a percent of total plan assets.
Yeah. And generally in those QDIA situations, the fees are a bit different than in the opt-in situation. Maybe I'll go back to you, Emma. Maybe take a step back. When we think about 2 decades of data, granted, some of that's on the fee, a lot of it's on the fee side, but what do you feel like is the most meaningful shift, and what hasn't changed maybe nearly enough in the last, 20 years?
Sure. I mean, on the fee side, Allie highlighted how fees have decreased meaningfully across investment management fees and record keeping fees. We haven't seen that same level or shift for managed accounts, but we are starting to see movement as we've had those negotiations. From a structural perspective, over the last 2 decades, we've seen a shift from participants being core menu users to more and more participants becoming 100% target date fund users. And in regards to the implementation, there's always been discussions on risk level, but where we have seen a greater focus in the last few years is on longevity risk. You have participants living longer, they are more reliant on DC plans to supplement their income in retirement, and that has argued for taking more risk in retirement as a way to try and combat longevity risk.
All right. And with 1 minute to spare, Allison, you get the final question. What is one trend that should prompt a committee discussion this next year?
Yeah, I guess I would take it back to the core menu. I know we've talked about target date funds a lot, but if there's a plan, if you fall into that group of offering 15 core options or more and haven't done an investment structure review in the last few years, where again, you're reviewing the number and types of options that are offered, it could be a good time to do that. So that might be an easy and a simple answer, but I do think it's important, again, to periodically revisit the lineup. And maybe you'll still offer 15 options next year, but it's important, again, to revisit it every once in a while and think about and better understand how the participants are actually utilizing the options that are offered in your lineup.
Perfect. All right. Well, I know we didn't get to everyone's questions, so we will follow up with you afterwards. Just quick housekeeping item. Today's recording will be sent out via email to those who registered. It will also be posted on our website in the coming days. In addition, the results of the survey, I believe, have been posted to our website already. Allie, Emma, Allison, thank you for your insights today. Very valuable as always. And thank you to our audience for tuning in to our annual Plan Trends and Fee survey. Thank you so much for your engagement. I was so impressed with all the questions that came through. So with that, hope you all have a wonderful week and we'll hopefully see you soon. Bye now.